Okay, imagine this. You've got a company provide something essential, right?
Yeah.
Like a utility. You'd think rock solid finances.
Absolutely. Stability is usually the name of the game there.
But what if that same company, even while looking pretty good on paper, suddenly drops a going concern warning? That just sounds contradictory.
It's definitely a situation that makes you pause, and it's worth digging into.
Exactly. So that's our mission today. We're taking a deep dive into the latest 10Q filing from RGC Resources, Inc. This covers the period ending March 31st, 2025.
Right.
We want to pull out the key insights, look at their operations, what's happening financially, basically give you a shortcut to understanding this complex situation for a regulated energy company.
And just for context, RGC Resources, they're mainly about selling and distributing natural gas. They do this through Roanoke Gas Company and RGC Midstream LLC, both wholly owned.
Okay.
Stock symbol is RGCO on the NASDAQ, and they're based out of Roanoke, Virginia.
Got it. So let's start with the foundation, the overall financial health, looking at the top-line numbers. And honestly, things look surprisingly strong at first glance.
They really do. As of March 31st this year, 2025, total assets were over $326 million.
Okay.
That's up, more than $5 million just since September 30th, 2024, when it was around $320 million.
And it's not just assets, right? Stockholders' equity grew too.
Yep, same story there. Climbed to nearly $118 million.
Wow.
Up from just over $108 million back in September. So yeah, balance sheet looks like it's strengthening.
So assets up, equity up. What about profits? How do they do there?
Profitability also looks positive. For the 6 months ending March 31st, 2025, net income was almost $13 million.
And how does that compare to last year?
That's a pretty noticeable increase from the same period in 2024 when it was just over $11.4 million.
Okay, solid growth and earnings per share, EPS.
That reflects the trend, too. Basic EPS hit $1.26 for the first 6 months of fiscal 25.
Up from?
Up from $1.14 in the same period for 24.
Okay, so good growth across the board. Let's look at operating revenues then. How did that track?
Revenues were also up. For those 6 months ending March 31st, 2025, they brought in almost $63.8 million.
Versus about $57 million last year, right?
Exactly. And what's really telling is where that revenue comes from. Almost all of it, nearly $63.7 million, was from their core gas utility operations.
So the main business is driving the growth.
Precisely. So you look at all that assets, equity, income, revenue, and it seems like they're doing well, even improving.
Yeah, which makes that going concern warning we mentioned earlier just stand out even more.
It really does. It's a stark contrast.
So here's where it gets, really interesting, maybe a bit confusing given those numbers. The 10Q explicitly states, substantial doubt exists about the company's ability to continue as a going concern.
That's language regulators and investors take very seriously.
Absolutely. So what's the actual problem? If revenues and profits are up, where's the doubt coming from?
It boils down to RGC Midstream, that subsidiary we mentioned. They have a significant amount of long-term debt maturing soon.
How much are we talking?
About $35.6 million. And the key issue is that this matures within the 12 months after the filing date, March 31st, 2025.
And that amount, is it manageable?
Well, that's the crux of it. That $35.6 million is more than the company's currently available liquidity to their cash and other assets they can easily access.
Okay. So even with decent operations, they have a specific near-term cash crunch tied to this debt coming due. What's management saying they'll do?
They have a plan. They intend to refinance $26.6 million of that debt before the end of this calendar year, December 31st, 2025.
And the rest?
The remaining $9 million, they're targeting refinancing before May 2nd, 2026.
How likely does that seem? Are the banks playing ball?
Management says discussions with their lenders have been positive, and interestingly, they're pointing to the successful startup of the Mountain Valley Pipeline, the MVP, as a factor that supports their ability to get this refinancing done.
Okay, so the MVP operations are tied into lender confidence. But what does this going concern warning mean, technically? Under the accounting rules, like ASU 2014-15.
Right. Basically, it means that management's current plans and resources aren't, on their own, enough to alleviate that substantial doubt about continuing operations for the next year. They need something external to happen specifically, successfully executing that refinancing with third-party lenders.
So the plan relies on others agreeing. It's not fully within their control yet.
Exactly.
Which really brings up a core question for you, listening. How do you weigh this serious short-term liquidity risk against a backdrop of improving operational performance? It's quite the puzzle.
It certainly is.
And this puzzle gets even more dimensions when you layer in the regulatory world they operate in. Utilities aren't exactly free agents.
Not at all. The Virginia State Corporation Commission, the SCC, is the big player here for Roanoke Gas. They regulate pretty much everything, service terms, conditions, and crucially, the rates customers pay.
It's a very involved relationship.
Yeah.
And they were just involved in a major rate case, weren't they? The 2024 rate case. Can you walk us through that? It hits the company's revenue and, the customer's wallet.
Sure. So back in February 2024, Roanoke Gas went to the SEC asking for an increase in their non-gas base rates,
How much?
about $4.3 million annually. They also wanted to bump up their allowed return on equity, basically, their profit margin from 9.44% to 10.35%.
Why the increase?
They cited higher costs of capital,
Yeah.
interest rates were up, making borrowing more expensive, and they argued they needed a higher return to attract investment.
And did the SEC just approve it?
No, it's usually a process. First, the SEC allowed them to implement interim rates starting July 1st, 2024, but these came with a catch: they were subject to refund.
Meaning if the final rate was lower, customers would get money back.
Precisely. Then, in October 2024, Roanoke Gas and the SEC staff reached a settlement agreement.
For less than they asked.
Yes, slightly less. The settlement was for an annual increase of about $4.1 million, so $4.08 million to be exact, and a return on equity of 9.90%.
Still an increase, but not quite what they initially wanted. Did the SEC commissioners approve the settlement?
They did. The final approval came through on April 10th, 2025.
Okay, so that means refunds.
Yes. Since the final approved rates are lower than the interim rates customers were paying since last July, customers should expect refunds. The filing indicates that'll happen in the third fiscal quarter.
Good to know. Now, besides these big rate cases, you mentioned regulatory mechanisms. These alternative revenue programs, ARPs, what exactly are those?
Right. ARPs are really important tools for regulated utilities. They're mechanisms pre-approved by the SEC that let the utility adjust revenues based on factors outside their direct control or to recover costs for specific programs between those big rate cases.
So they're like smaller, more targeted adjustments.
Sort of, yeah. And importantly, they fall outside standard revenue accounting rules, ASC 606, because they're regulator-driven adjustments, not typical sales revenue.
Okay. Can you give us some examples, like the Weather Normalization Adjustment, WNA?
Sure. The WNA basically smooths out revenue impacts from weather. Natural gas usage is heavily tied to temperature, right?
Definitely. Colder winters mean higher bills.
Exactly. So if it's an unusually warm winter and people use less gas, the WNA allows the utility to collect a bit more to make up for the lower volume based on a 30-year average temperature. It works the other way, too, if it's colder than normal. It adds revenue stability.
Makes sense. What about the SAVE Plan rider?
SAVE stands for Steps to Advance Virginia's Energy. This rider lets Roanoke Gas recover costs for investments in specific, eligible infrastructure replacement projects. Think replacing old pipes without going through a full rate case.
So it speeds up infrastructure upgrades.
That's the idea. For fiscal 2025, they got approval for about $1.39 million in revenue through the SAVE rider. Interestingly, this was less than they proposed.
Why was that?
The SEC staff, when calculating the return component for those investments, used the cost of capital figure from the previous rate case, 2022, not the newly proposed higher one.
Ah, so does the company just lose out on that difference?
Not necessarily. The filing says those differences will be trued up later, meaning they'll reconcile the amounts in future filings, likely collecting the difference then, once the final cost of capital is locked in across the board.
Okay, a true-up mechanism. And the last one mentioned was the RNG rider. Renewable natural gas.
Right. This allows them to recover costs tied to investing in renewable natural gas facilities and related operating expenses. They got about $356,000 approved for fiscal 25.
And same situation with the cost of capital calculation.
Yep. Same reasoning from the SEC staff relying on the older rate case data for now, and also subject to future true-ups. These ARPs really show that constant negotiation between the utility needing to recover costs and the regulator protecting customer interests.
It's a complex balance. Okay, so regulation is one big piece. Let's pivot to another major factor influencing RGC's situation, especially that refinancing ability. The Mountain Valley Pipeline, MVP.
Yes, a huge project with long-term implications. RGC Midstream holds an equity stake in the pipeline's owner, Mountain Valley Pipeline, LLC.
How big a stake?
It's less than 1%, so not controlling, but still significant for Midstream.
And the big news is that after years of delays and controversy, The MVP is finally operational, right?
Absolutely. That's a major milestone. It officially started commercial operations for interruptible service on June 14th, 2024.
Okay.
And then the really key date for its main purpose. Long-term firm capacity contracts began on July 1st, 2024. It's up and running.
What does that shift from construction to operation mean financially for RGC? How does the accounting change?
It changes quite a bit. Before it was operational, Midstream recorded income through something called AFUDC allowance for funds used during construction.
Which is not actual cash.
Exactly. It's an accounting method allowing utilities to capitalize the financing costs during long construction periods. It boosts earnings on paper, but isn't cash flow. Now that MVP is operational, AFUDC stops.
So what replaces it?
Now, RGC Midstream recognizes its share of the actual earnings from the pipeline LLC. Plus, there's a favorable adjustment from amortizing a non-cash basis difference over the pipeline's expected 40-year life.
Okay, so earnings recognition changes. But you mentioned cash flow earlier, especially regarding the going concern. Does MVP operation help there?
Oh, definitely. This is maybe the most tangible benefit right now. RGC Resources actually received cash distributions from the pipeline LLC.
How much?
About $1.8 million during the first 6 months of fiscal 2025. And they expect similar cash distributions going forward, likely quarterly.
That's significant. A new, steady stream of actual cash coming in the door.
It really is. And certainly helpful given their other financial pressures.
And this isn't their only pipeline interest, is it? There's the Southgate project.
Correct. Midstream also has a small investment in the Southgate project, which is planned as an extension off the MVP. That one's still in the design and permitting stage, though. Target completion is way out in 2028.
So more potential growth down the line. Okay, let's wrap up with how they're managing their existing debt load and dealing with interest rate risk.
Right. Starting with Roanoke Gas, the utility subsidiary, they recently amended their unsecured revolving note that's like a credit line.
What changed?
They increased the borrowing limit from $25 million up to $30 million, and they extended the maturity date out to March 31st, 2027.
And the interest rate, fixed or variable?
It's variable, based on term SOFR, which is a common benchmark rate, plus a margin of 1.25% or 125 basis points. As of March 31st this year, they only had about $4.1 million drawn on that $30 million line.
Okay, now Midstream's debt. That's the focus of the going concern issue. What's happening there?
They've been making adjustments, too. In March 2024, they amended their main non-revolving credit facility, the Sixth Amendment, actually.
What did that do?
It increased the facility amount to $25 million and pushed the maturity date to December 31st, 2025. It also has a variable rate, term SOFR, plus a spread between 1.55% and 2.00%.
I remember seeing something about another new facility, too.
Yes. In May 2024, they set up a new $9 million revolving credit facility that matures May 2nd, 2026. They used the funds from this new revolver to pay off a different $9 million note that was out to mature, so shuffling things around.
And wasn't there something about pausing payments?
Right. On a separate $8 million term note, they got temporary relief. Quarterly principal payments were suspended from April 1st, 2024, but they did resume on April 1st, 2025. So some breathing room there for a bit.
That's a lot of variable rate debt across both subsidiaries. That exposes them to interest rate hikes, doesn't it? How do they manage that risk?
Good question. They use derivatives, specifically interest rate swaps.
Okay.
And their stated policy is crucial. They use these only for hedging, meaning managing existing risk, not for speculation. The goal is to swap their variable interest rate payments for fixed payments, giving them more certainty on borrowing costs.
So they lock in rates on some portion of their debt. Do we know how many swaps they have?
As of March 31st, 2025, the filing details 4 active swaps. 2 are for Roanoke Gas, one covering $15 million of debt at a fixed rate of 2.00%, and another for $10 million fixed at 2.49%.
And for Midstream?
2 for Midstream as well. One covers $14 million at a fixed 3.24%, and the other is on $8 million of principal, fixed at 2.443%.
And how are these treated accounting-wise?
They qualify as cash flow hedges. So the changes in the fair value of these swaps are mostly recorded in other comprehensive income on the balance sheet, not directly hitting net income each quarter, which smooths earnings volatility.
Okay. So despite the refinancing challenges and the going concern warning, were they actually meeting all the terms of their existing debt agreements, like the covenants?
Yes, that's an important point. The filing states that as of both March 31st, 2025 and the previous fiscal year end, September 30th, 2024, RGC Resources was in compliance with all its debt covenants.
So they're walking a tightrope with liquidity, but haven't tripped any covenant wires yet.
That seems to be the situation, yes.
Okay, so let's try to bring this all together. We've done a deep dive into RGC Resources. We see a regulated utility showing, pretty solid growth in key areas like assets, equity, profits.
Right, the operational side looks decent.
But, and it's a big but, they're grappling with this significant short-term liquidity crunch.
It's serious enough to trigger that going concern warning, mostly tied to RGC Midstream's debt maturing soon. And we saw how they operate under the close watch of the Virginia SEC, managing rate cases and using these ARPs, the alternative revenue programs, to handle things like weather impacts and infrastructure investment recovery.
Trying to balance the company's needs with customer costs. And then there's the huge strategic piece, the Mountain Valley Pipeline investment.
Yeah, finally operational, which is a big deal. It stops the non-cash AFUDC income, but starts generating actual earnings and, crucially, bringing in real cash distributions, about $1.8 million in the first half of the fiscal year.
And underpinning all this is their debt management amending facilities, using swaps to hedge interest rate risk, while importantly staying compliant with existing loan terms.
It really paints a picture of that intricate dance, doesn't it, between the utility, the regulators, and these massive capital-intensive infrastructure projects.
It absolutely does. And it leaves us with a pretty provocative thought, I think.
Yeah.
We see these regulatory mechanisms, right? They're designed, in theory, to balance protecting us, the consumers, with keeping the utility financially stable enough to operate. But how well do these systems truly adapt to the kind of economic pressures we see now? Things like persistent inflation, sharply rising interest rates, and just the enormous amount of capital needed for energy infrastructure today, whether it's pipelines or transitioning the grid.
That's the multi-billion-dollar question, really.
Yeah. It makes you wonder, what does this constant push and pull mean for the future of energy services? And maybe more directly for you, what does it mean for the bill you pay every month? Something to think about.